Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I trust you had a restful weekend and are prepared for a productive week ahead. As we normally do on a Monday, we have a heavy economy and financial focused video today. So let's move through the major updates on this front. Over the weekend, the Central Financial and Economic Affairs Commission had its first meeting following the October leadership reshuffle. At the event, General Secretary Xi Jinping pledged to further increase the party's already strong control over the economy. According to state-run CCTV, Xi, who also heads the commission, expressed that the party must continue to, quote, centralize and unify leadership of economic work, end quote, to achieve a, quote, full-fledged, advanced and secure modern industrial system to maintain strategic advantages in future development and international competition. End quote. The statements are yet another reminder of the status direction the Chinese economy is moving towards. At the meeting too, so-called population policy was also discussed, with Premier Li Qiang expressing that China needed to build a birth-friendly society to achieve an appropriate level of birth rate and the overall size of population. Details regarding how to achieve this, however, were not disclosed. Meanwhile, according to data from the State Administration of Foreign Exchange published yesterday, Sunday, China raised its gold holdings by about 8.09 tons in April, representing the 6th straight month of gold reserves growth. China increased its reserves by about 120 tons in the 5 months through March. This represents the first gold buying spree since a 10-month run that ended in September 2019. This is a trend that can be observed all around the world as central banks are responding to escalating geopolitical and economic risks. The World Gold Council recently said that volumes are at historically elevated levels. Quote, the appetite for gold has helped prices scale near record highs as markets fret over a slowing U.S. economy and signs of persistent credit stress. Geopolitical risks stemming from increasingly fragile Sino-American relations are also boosting the safe haven appeal of bullion. End quote. Some commentators argue that Beijing is hedging its geopolitical bets in other ways too. For example, UK-based outlet The Guardian argues in an article today that in the last year, quote, a drive to insulate China's economy from dollar-based sanctions has emerged as possibly the most important incentive for decoupling from the dollar, as China looks to prepare for the possibility of conflict with Taiwan. End quote. The outlet observes that between March 2021 and March 2023, China's share of the trade finance market more than doubled. This is a complex topic which we will need to explore in more detail in a future video. Meanwhile, UK-based financial media outlet The Financial Times reports today that US and European companies have blamed disappointing earnings on a slower than expected economic rebound in China. Quote, after its sudden reopening from pandemic curbs prompted over-optimistic growth forecasts. End quote. This last week, cosmetics group Estee Lauder saw its sharpest one-day share price fall on record due to, quote, more gradual than anticipated, end quote, recovery in China. Other companies have expressed similar frustrations. Last week, chief executive of hotel chain Hilton expressed, quote, China won't contribute what I had hoped it would this year, end quote. And Qualcomm chief executive told investors just a few days ago, quote, the overall expectation was, following the reopening, the China market was going to bounce back. We have not seen those signs yet, end quote. The Financial Times observes, the comments came despite official figures showing a robust start to the year for China's economy. The divergence reflected the fact that some observers have simply been too optimistic in predicting an explosion in activity, end quote. Perhaps if these industry leaders were watching China Update, they would not have been quite as surprised. But you guys do watch China Update, for which I'm very grateful. And if you're enjoying today's video, don't forget to hit that like button. Liking and subscribing and sharing are huge helps for the channel. And for anyone who can go that extra mile and help me keep the channel financially sustainable, I primarily rely on subscriber support in order to keep going. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. A few more quick economic focused updates. According to data from the National Energy Administration, which was just published, in the 3 months through March, China added 33.66 gigawatts of grid-connected installed solar power capacity, representing an increase of 155% year-on-year. Of course, last year was the zero-COVID period, so we note that this huge increase is off a low base. Chinese exports of solar panels, driven mainly by European demand, themselves facing their own energy crisis, also saw robust growth. According to data from industry consultancy InfoLink Consulting LLC, in the first 3 months, China exported modules capable of generating 50.9 gigawatts of electricity. This was up 37% year-on-year. On this general theme, last week, leading Chinese battery materials supplier Puhailai New Energy Technology announced a massive $1.5 billion investment plan to build a factory in Sweden in order to meet future European demand. The Shanghai-based company said the factory will conduct research and produce key components used in EV batteries. By 2026, according to the company, the facility will have an annual capacity of 100,000 tons of the relevant lithium-ion materials, the largest of any facility of its type in Europe. Next up, local government debt has become a hot topic recently. Of course, regular viewers of China Update know that it's also a topic which we've been following for some time now. Over the weekend, several major Chinese financial media outlets produced pieces looking at the increasingly concerning policy challenge. Indeed, more than one called the challenge a crisis. We have done deep dives into this topic of local government debt several times in the past, so we will try not to repeat ourselves too much here. But it is worth looking at some of the points raised by these major outlets to get a sense of how Chinese experts, financial media, and analysts themselves are discussing this issue within China itself. Of course, regular viewers are familiar with the basic outline of the problem. Since 2017, the balance of local government debt has been rapidly increasing at an average annual rate of 16.3%, far higher than nominal economic growth. At the end of 2021, the local government debt-to-revenue ratio was 105.8%, exceeding 100% for the first time. In 2022, the scale of local government's issuance of special bonds exceeded 5 trillion yuan for the first time, an all-time high that was more than double the issuance size in 2019. These are pre-pandemic levels. Local government's special bonds are supposed to only be issued for public welfare projects that generate a specific return, and then are supposed to be repaid with corresponding government funds or special revenues over a set period of time. As of the end of 2022, though, the balance of local special bonds reached 20 trillion yuan, accounting for more than 20% of the bond market. Analysts now observe that these special bonds have simply become de facto general debt. Last month, as we have seen, the poor southwestern province of Guizhou appointed a state-owned asset management company to help it restructure its massive debt load. A few weeks before this, a local think tank warned that the province could now no longer sustain itself financially without external, i.e. central government, support. So we can see local government debt continues to surge, some poor provinces can no longer sustain this debt level, and local government debt across the country shows no sign of slowing as we move into the future. Let's examine some of the most recent discourse on this topic. We will look at some comments made in a Caixin editorial, as this outlet represents one of the most widely read and respected financial outlets in the country. Quote, "Tackling the mountain of hidden debt accumulated by China's local governments is once again at the top of the political agenda. Concern about the risks to the financial system and the sustainability of local government finances from trillions of yuan of invisible liabilities has stretched to the pinnacle of policymaking." Xi's exhortations and the string of statements and comments from Finance Minister Liu Kun underscores the limited progress that's been made over the past decade to contain the financial liabilities of local authorities that aren't explicitly reported in their official budgets. There is no publicly available official data on the current scale of hidden debt, but
Many analysts, including those at the International Monetary Fund, IMF, have come up with their own estimates, which range from some 30 trillion yuan to more than 70 trillion yuan. End quote. The writers are referring to the most recent IMF consultation report on China, which the PRC Ministry of Finance has rejected as being inaccurate, though these Caixin analysts do not expressly themselves reject the report. The IMF report estimates that as of December 2022, explicit local government debt was about 35 trillion yuan, $5 trillion, with implicit or hidden debt double the size at 70 trillion yuan or $10 trillion. According to the report, 56 trillion yuan of this hidden debt is in the form of local government financing vehicle debt, which, according to the IMF, is forecast to surge to over 100 trillion yuan by 2027. We will have more on this growing local government debt crisis later in the week. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Monday wherever you are, and I will see you all tomorrow.